Good evening, everybody. This is Victoria here from Stock Market Institute. We welcome you for the session or discussion with two Kirans here who are the market professionals with regard to mid-year economic review 2022. You get to learn a lot of things. You get to listen to a lot of things. Topics has already been mentioned on the display before we started this session. And I welcome all of you. I'm sure you're going to have a lot of input knowledge, and people who are going to talk are the professionals. As I said, they have done a lot of research. It's been almost 10 days since they've been doing a lot of research on the topics mentioned. You can have, if you have any questions, I think this is not a Zoom meeting, it is a webinar. You may have to raise your hand and ask for questions or chat box is there, and we will try our best to answer all your questions. If anyone is looking for a certificate, you may have to click on the link on the chat box, give all your details, your full name that has to be displayed on your certificate, and link is there. You may have to give all your details so that we can issue certificate for this session. So I welcome Mr. Kiran K and Kiran Bindu for this wonderful discussion forum. Over to you, sir, both the sirs.
Thank you, madam.
Thank you.
I think I would request to be allowed to be sharing my screen on both the devices that I have joined on, if that is possible, because I'm using my desktop to share my presentation. Thank you. I think I'm rejoining as a panelist. I thank everyone for their patience while I just... All right. So, thank you, Kiran Kumar sir, for joining me today this evening.
Thank you, sir. Likewise.
So, we will be covering the period from 1st of January 2022 to 31st of June 2022. We will not be doing any sort of forecasting. We will just be reviewing the 6 months that has gone by. And to be very specific, we will be reviewing Q4 of 21-22 financial year. That is January, February, March. And Q1 of the current financial year, 22-23. And we may refer to the Q3, Q2, and Q1 of 21-22 just to establish whether economic indicators are moving in those quarters upwards or is it going up and down. So that is the time frame, and knowing the time frame in which we are talking about is important. So this year, IMF has lowered the global growth expectations because of rising global stagflation, which is basically economic stagflation and inflation. And this pressure has been caused due to the Russia-Ukraine war, and it has magnified the global supply chain bottlenecks. And this has led to global quantitative tightening, which means the central banks around the world being a little worried about inflation. Here is the graph that tells you the advanced economies. Look at their inflation, look at especially the US. US inflation has shot up, and so has the UK, while Japan, inflation is unheard of, but still you will see the Japanese economy is also suffering from inflation. Compared to them, the emerging market inflation is still a little bit under control. So when inflation is on the horizon, the central banks around the world withdraw liquidity, and they do that by raising the what is called as the interest rate. So in India, in May 2022, RBI raised interest rate by 40 basis points, and it again hiked interest rates by 50 basis points in June, thus taking the interest rate to 4.9%. What this has done is this has hiked up the rate of interest on housing loan or automobile loan, and thus quenches the demand. You can say that it kind of curbs the GDP growth rate, because central banks around the world believe that inflation is a greater danger than GDP growth rate. In May 2022, RBI decided to increase the cash reserve ratio by about 50 basis points, withdrawing excess liquidity from the banking system. According to the provisional GDP estimate that was released in May 22, the Indian economy in 21-22 has fully recovered to the pre-pandemic real GDP levels. Yes, you'll be surprised to know that it has recovered, and I will show you the data in the coming slides. I will not talk about in percentage terms, but just hold on to that fact that it has recovered to the pre-pandemic levels. And this growth momentum was also seen in the earlier quarters of 21-22. So there are a lot of high frequency economic indicators. Before I go to the high frequency economic indicators, take a look at the inflation in the advanced economies. The previous one was the interest rate in India, which went up from about 6.5% to about 7.4% odd. That is a 13% increase. Notice the interest rates have moved up in other economies as well, and interest rates have moved up. This is the interest rate, and this is the inflation. The inflation data is there on your screen. Notice how steep the lines are in advanced economies as opposed to the emerging markets, the developing economy. India is somewhere there right in the middle insofar as inflation is concerned. So this is why the central banks of the country, various countries have risen interest rate in the first half of this year, and there are going to be lingering effects of that. In India, the Purchase Managers Index, which is a measure of the economic activity, has reached its highest level in the past 18 months. It is completely in contrast with the Purchase Managers Index in US and UK, which have been declining from April to May. They have been showing declining tendencies. So inflation has remained persistent at around 6% for 4 consecutive months in India. What this does is it puts pressure on the government's ability to do certain things. The government increased the excise duty on diesel and petrol. It cut the excise duty on diesel and petrol because the people were hurting. And when it cuts the excise duty, it obviously hurts its own revenue collection. And this increases the gross fiscal deficit. And this, if they did not do this and they continued on the same line, people would have gotten hurt. So to help the people, they have cut the excise duty and thereby taken a hit on their tax collection. This increases the gross fiscal deficit, and it also increases the current account deficit, and it leads to the weakening of the rupee, and it aggravates external imbalances, which can cause rupee to weaken further in the face of what rupee has already weakened. So now what has caused inflation in India? The consumer price inflation. Notice that the consumer price inflation is in light yellow. And notice the food inflation. The food inflation has a line of its own, and it's a very important component. So we are seeing that there are a lot of imported components of high inflation, primarily due to this elevated global prices of crude oil and edible oil. And the heat wave in India also contributed to the significant rise of food prices. So going forward, the international crude oil prices may behave in a way that we don't want to speculate, because I've already told you that we are not going to be speculating on what is going to happen in the future. Let us focus on what causes the consumer price index in India to shoot up. There is this vegetable related inflation. The prices of vegetables shot up significantly. And then there is crude oil, vegetable oil prices. Both are used in consumption of food items, so preparing food items. Even having said that, India is relatively better placed to face the challenges that the next 6 months may throw up, because of its financial sector stability and because of the vaccination success. And there's a lot of pent-up demand in India, which can cause the capacity expansion of the private sector going forward. Now look at the high frequency indicators. I want to spend some time on high frequency indicators. This tells you straight away the economic activity. So in April and May, they signaled an uptick in economic activity in 22-23, sustaining the growth momentum. And the GST revenues for May 22 was much higher than the May 21 of last year. And also the daily e-toll collection, e-way bill generation, and Google Mobility Index, all of these things were higher in May 2022 as compared to the year gone by, which tells you that there is a significant bounce back of economic activity. And then there is a very reliable source of economic activity. I want you to just look at from January 22 to April 22, you will see the slight uptick in the curve. That is the index of industrial production. There's a slight uptick. Still, the industrial production has not come back because of the global supply chain issues. And 8 core industries also, there's only a slight uptick yet. So that has to show a nice bounce back. Then you will see the purchasing managers index of manufacturing on the left and purchasing managers index services on the right. Notice that massive bars, the last 4 bars after January of 2022 on both the sides, especially the service side, is really kicking in, which tells you that manufacturing is robust and also the services is also robust. So the composite, that is both combined together, the purchasing managers index was recorded at around 58.3 in May 2022, which was the highest in the last 18 months. All right. So one more very important thing to watch out for to make a sense of how your economy is doing is the consumption of power. So industrial and service activity, which has grown, has led to a rise in consumption of power and fuel in the economy. And summer heat is also responsible for the increase in power consumption. And there's also a pent-up demand in respect of this contact-based services like hotels, etc., which has added to fuel consumption. And you can see there, compared to the previous year, corresponding period of the previous year, COPPY, and the current year, and the year-on-year growth is extremely kind of encouraging. And then there is also demand for thermal power, which indicates a strong underlying demand for fossil fuels, despite continuous underinvestment in fossil fuel and a trend going towards renewable energy. Here is the electricity generation that we are seeing. If you will notice, this is for the month of April and May, as opposed to the last 2 years. It is a clear indication that this year we are consuming more electricity. So coal production, in fact, has not been able to keep up with the demand due to the supply chain bottlenecks. and the pent-up demand for energy as the economy is opening is leading to both cost push and demand pull inflation. So you see the stock of coal there, and it is dwindling, and the production and the offtake of coal production on the left side of the chart there, all giving you an idea as to the production is also increasing, the offtake is also increasing. Then you have hotel occupancy. Hotel occupancy, before that I come to the bank credit. So bank credit is going up. That means corporates are borrowing money. There is a smooth flow of credit to the banking sector. Large cap private banks are well capitalized and they have adequate provisioning to indicate a robust growth in this credit offtake. And then you will be surprised to know that the wedding season is kicking in, and coupled with the reopening of the economy, the demand for contact intensive services has reached the pre-pandemic levels. So you see the average hotel occupancy rate has shot up compared to the 2019 levels. It has now come back to that same level of 2019 levels. All right, then so yeah, the big thing is to fix the supply chain bottlenecks. So what has the government done? The government has taken some proactive measures. They have waived off customs duty on certain imported raw material, which are used in steel and which will reduce the cost of production. And because of that, they have created favorable environment in automobile and construction sector and help boost the export competitiveness. So this gives you the consumption of steel and the production of steel, both of which have shown reasonably increasing trends. Then cement production, which is very critical for the housing sector to do well. That also is doing pretty well in the 6 months that has gone by. And then we are facing consistent semiconductor chip shortages, and demand for automobile has still not reached the pre-pandemic levels because of that. Once this supply chain bottlenecks and semiconductor shortages is fixed, then that sector also we can expect them to do much better. Here is the All India auto sales data given to you. Not that impressive compared to October of 2021. Two-wheeler and three-wheeler sales has really not, because it is sluggish because of this semiconductor chip issue. And then you will you'll be happy to note that the merchandise exports has reached about $38.9 billion, $38.9 billion in May 2022, and it is registered a growth of about 20.6%. So you have heavy engineering goods, raw material, electronic goods, and all of these things that are doing well. Then merchandise imports are also growing rapidly. So if exports grew by 20.6%, imports grew by about 62.8%. And if exports were about 38.9 billion, the imports were 63.2 billion. And basically because of the import of gold, we are voracious importers of gold. Okay, and because of the wedding season, a lot of weddings, it appears, has been postponed from 21 to 22, and that is because of the pandemic-induced restrictions were there. That's why people have postponed the weddings also. So that is also causing a heavy import of gold. Now, here are some data with related to financial markets related indicators that we can track. One is the copper prices. Copper, as you know, is a product which is of significant use in industries. So that has really shot up in the recent times, but the prices is still okay, sluggish only. And then USD INR, INR is losing value rapidly against the US dollar. Not only INR, all the emerging market currencies are also losing value. And then the India's 10-year interest rate is now at around almost 7.4%. India has a persistent problem with high interest rate because of high inflation in India. Then India VIX gives you the story of the fear index that is there in the stock market. In the middle there was a lot of fear with regards to the market collapse. And as the markets have corrected a little, the fear has also receded a little, but it is still at the long-term average rate of about 20, the fear index. Then if you look at other markets, how we are doing, Shanghai was already at a reasonably high level. If you look at the markers that I put there, the little white lines that I have drawn there, notice this entire year, all markets are down. It is only a question of who is down how much, but all markets are down. India has fallen from a little higher level to a lower level as compared to the rest of the market. So you can say that the fall is steeper. So some of the blue chip companies, they are literally at the level where they started the year. If you will see, just today's news, Tata Consultancy Service dropped by about 4%. So NASDAQ also has dropped significantly. In fact, all the indices are year on year down. So that is my small presentation to you. I would like to acknowledge the efforts of my research assistant, Bhaskar Kasera, who helped me put together this presentation. He's a student at one of the colleges that I teach. So with this, I will give the floor for Professor Kiran to add to the knowledge base that we have developed, and then we will be open for taking a few questions. Sir, please.
Yes, sir. Yes, sir. Thank you. Thank you so much, sir. I hope I'm audible to all of you, sir, if you can confirm.
Yes.
Is my
yes.
audio clear? Okay.
Yes.
I think, Anandu, I need a screen share access. It's disabled for now.
Just hold on. Huh?
Sure.
It is done. You can check.
Yes. No. No, I don't have.
Just hold on.
Sure.
So you have the access, sir. You can be the you can share the screen, sir.
No, it says host disabled participant screen sharing.
Okay, 1 second. Now you can try, sir.
Anand, I'm sorry. No. Okay, I think you are making Mr. Kiran Bindu as the host. My initials are KV.
Yeah. Kiran Bindu, sir, you can just make him as a host, sir.
I think he has to make me a host. Yeah.
Yes, sir. Kiran, sir. Kiran Bindu, sir. Just a second, sir.
Yeah.
Can I probably just rejoin the meeting? That way I won't be a host.
Yes, sir. I think if you leave, it makes someone else.
Yeah, okay. I will do that.
Kiran
It is
Bindu,
still, yeah, he's still the host. I think he has another login. Professor Kiran, I think you're still the host through your second connection, maybe through mobile.
Because now I can't leave. I can only end the seminar.
Oh, okay.
sir, don't end the seminar. You can just make somebody else co-host, probably me, the co-host.
Just 1 minute. Let me just
Or
see
host,
if I can.
at least.
I
Okay. I got
will
it, sir. I got it,
just-
sir. I got it, sir.
Yes,
Okay.
yes. It's done. It's done. Okay,
Yes.
I have the access. Thank you. Thank you so much.
You're most welcome, sir.
Okay, so good evening all. Welcome back to another session. Okay, we have met, most of us have met previously, and yeah, I'm taking up a challenging task now because Professor Kiran had excellently covered literally all aspects that we could have discussed. Amazingly presented. So thank you so much, sir. So maybe as I expected, I did. I thought I will take up some, statistics, some numbers, which might probably the gaps that we haven't seen. So basically my coverage would talk about, of course, not from A to Z, but in between we'll take some interesting statistics and we'll try to make sense out of it. That's how my next 15 to 20 minutes are going to be. So I will take up some macroeconomic numbers and we'll try to see how we can interpret that. And then we also will talk about the equity market numbers. I'm calling numbers because I'm not going to be talking about a lot of theory here. Some contemporary numbers, graphs and statistics. Using that, we'll try to understand. And also, yes, global financial market numbers, global market update is also something that I want to cover. So sources of my data, of course, I'm going to be using a lot of data throughout my presentation. So I just summarized all data has been taken through different sources. Of course, Bloomberg, RBI, and IMF is the core source of data. And I've also accessed one of the market outlook report by Capital Market for my global market numbers. And there is one part which I will be concluding with one of the survey that McKinsey has conducted. And just I have that one data point that I would like to use to conclude my speech. So let's directly get into the agenda now. So the macroeconomic numbers, like Professor Kiran has already covered a lot of things. So a few of them which I found which are interesting, and probably we might have to not miss this, when we are analyzing the economic numbers or when we're doing a review of economics. So one is globally, this is the trend, across the world. It's not just India. Across the world, monetary, policy rates are being increased. Like sir used the word quantitative tightening. Okay, we have lived through a era where we have seen most of quantitative easing. So now we are in the quantitative tightening era. Of course, we all know the reason: the pandemic and heavy spending on the healthcare by almost all the countries, and especially in the last few months, especially the period which is under our review, the major event that has affected almost every other country's budgets and their estimated bounce back. Right? I mean, when we started the year, we were actually looking at bouncing back, right? We were using words like V-shaped curve, J-shaped curve, right? Economic recovery, it's economic recovery, low base numbers, and on which we will, take the economy to next level. Of course, India was the most positive, most bullish economy, and of course, many other economies, including advanced economies. But the Ukraine war was one of the major events, which has kind of course, might not have like literally affected the whole world already yet, but definitely it's been one of the stumble or a block for the recovery path. So having said that, one of the statistic that I found is the negative yielding debt. Okay, the percentage of that has been coming down. Okay, not percentage, but the quantum of the negative yielding debt. So when we say negative yielding debt, we're talking about from the investor's point of view. Okay, when a debt investment is giving a return lesser than what a government bond or a government yield might be giving. All right, so this mostly happens when the corporates ratings of the bonds go down. So this was one of the statistics that I found. You must know about. Secondly, the institutional investments into here I'm focusing Indian markets. So institutional investments, if you see, there's an interesting trend at this part. Okay, there is a FY22. Whatever is the DII, this is the FII inflows. Despite the conditions, a lot of FIIs are taking out their funds from India, which of course is not a great sign in the given situation. But yeah, they are going out. But thankfully, the domestic institutional investments, including the insurance companies, mutual funds, provident funds, etc., they are taking care of that. There is a counterflowing that's happening. So that way, your overall investment environment is not really that negative. Okay, in fact, so much so that the FII outflows are less than the DII inflows in total. So that way it leaves a margin of net investment. So I think that's been a trend for the last 2-3 years that we've been seeing. So that is something that you might observe. It's both. This both part that I'm talking here, they both belong to the period under our review. This is another thing that you should keep in mind. Then the currency part. So Indian currency, of course, you all know it's almost reaching 78, 79 level now. So there's a 4.13% of depreciation of Indian currency against USD. Okay, which is not a great sign, okay, because most of our exports get affected because of that, and we have our large IT companies which are IT, and many sectors depend on the currency, and currency depreciation is at times positively impacting these industries. At the same time, there is also negative impact on the other sectors where we are also importing a lot of things. So that way, but having said that, the silver lining here is that we can still pat our back and saying that we are still better than Chinese renminbi or Swiss franc or Malaysian euro also. Okay, or even advanced economy currency like yen. Okay, we are definitely much better than them in terms of. So this credit mostly is given with most of the research that I have done, reviewed. This credit goes mostly to our self-sufficient theme that we have adopted, and a lot of steps being taken towards that. Okay, that Atmanirbhar Bharat, the budget, if you remember in the budget speech, there were 4 themes, right? One of the primary theme that the focus of the budget this year, and of course, a lot of allocations have been made. They were also towards, the self-sufficiency, Atmanirbhar thing, right? So that is one. In addition to that, a lot of infrastructure spending, and boosting the FDIs, okay, through the Make in India theme. All right, so most of these have contributed for this. Okay, that's another point that you need to keep in mind when we're talking about economic review. Some indicators for the industry, of course, Professor Kiran has covered it individually with certain industries, certain sectors. I just have this data which is taken from the GST data, GSTN database. So one is of course the automobile, two-wheelers, passenger vehicles, medium and heavy commercial vehicles, and light commercial vehicles. So you can see that the trend wise, there is definitely an increase in the return, that sorry, not the return, but the sales has been going up. Okay, 6% is the increase in the passenger vehicle sales. But again, should we be jumping in joy with that? Probably no, because the base, the last 2 years, if we take as the base, has been lower. Okay, so considering that, I mean, it's not a number to be very happy about. At the same time, it's not a bad thing. It was kind of expected. Okay, gross GST collection is also been like 13-12%. It's increased an average of around 10 to 11%. If you see this part. One more interesting thing you might want to look at is the manufacturing PMI, Purchase Managers Index and Services. So of course that's been talked about. As long as these numbers are more than 50, okay, these PMI numbers, if they are more than 50, we kind of conclude that it's an expansionary phase. That means the purchase managers are very bullish about their future requirement for the materials that they have to purchase. So when will a purchase manager be bullish? Correct. So he will be bullish when he has a promising orders and capacity utilization being forecasted for the next 6 months, 1 year period. So that way, as long as these numbers are still above 50, I think we should be safe there. But again, a number of 54, 55 is relatively lower, okay, for an aggressive market like Indian market, for example, considering the kind of scale that we operate in, the industries that we are present in, and allowance of FDI in so many sectors. Okay, I mean, including defense, now we have, we are allowing nearly 74%, right? So despite all that, if you're still at 54, 55, I think that's not a real, a bullish number to be very happy about. Right, but having said that, we are not in a danger zone. Okay, the future seems to be positive and bullish. Of course, I'm not predicting, as sticking to the theme of not predicting future, but yes, these numbers are used to understand what is coming in its way. So commodity markets, I'm just going to skip this because this is basically about all the commodity numbers are crazy. I mean, you all saw how the crude oil price has been moving with the Russia kind of disturbing the supply chain. Okay, so this may not be correct for now to interpret anything based on the commodity prices. They are haywire. I mean, we need a stable market and stable set of data for at least 6 months to 1 year to even comment whether this is going right or wrong. Otherwise, I would just like to conclude that the prices are simply volatile. Okay. That's one. And coming to equity market numbers, focusing more on the Indian equities, has been a positive market at the beginning of the period, but in the last few months, okay, the market has not been really that great. But of course, when we talk about equity market, we always talk from the long-term average point of view. Okay, long-term average point of view. But overall, there has been markets have not been really that bullish. Okay, but individual sectors have done well. Individual companies have really delivered a lot of things. Some IPOs have not really delivered, including the LIC IPO. Recent IPOs which came also have not really successfully delivered the kind of return that we were expecting. But of course, as you can see, you have the auto industry leading with companies like Mahindra and Mahindra, Tata going aggressive with their passenger vehicle thing, and FMCG is also leading. Okay, and power sector has also contributed, but most affected is IT industry. Okay, and the metal industry, again purely because of exchange rate and the commodity prices, fluctuating commodity prices. They are the ones who were most affected. Okay, so this is basically about Indian market indices. One other thing again, so that I generally keep track of is the earnings yield. Okay, sorry, this is not number of times. Okay, this is wrong way of interpreting. Okay, I should have deleted that. Okay, this is not applicable. Okay, there's a percentage basically. Okay, it's a percentage. See, we all understand the GSEC yield, right? So this is the government GSEC yield on government bond, and then you have the earnings yield. Now, earnings yield is calculated for let's say I think this is based on the Nifty earnings yield. So that means you have the 50 companies of Nifty. Their average EPS divided by average market price. So essentially the reciprocal of the P ratio, right? So this kind of tells you, I mean, irrespective of the dividend or the capital appreciation, as a corporate earning, how much are you earning per shareholding of the investor, right? That's basically earning yield. So generally we use it to determine the risk premium in the market. Okay, so if you see the risk premium in this market, is not much changed between 2021 22, but there was a chance that the risk premium could have been more positive here. All right, so this gap what we see, that is generally used as a risk premium, which still remains to be in the range of I would say 2% to 1.5% to 2%. That's the kind of risk premium that we're talking about for a market. So that is not a that's not a great accolade for the corporate performance. Even though quarter on quarter we do see companies showing a increased revenue percentage, increased earnings percentage, but it appears that that is not reflecting in the stock market. Okay, so I'm not saying corporate earnings have been bad. Corporate earnings are I mean, they are definitely giving a good rate of return, but the percentage of that as its market price is not much. That means the true valuation of these earnings are not happening. It might generally happen because of increased speculation in the market, but it can also happen because okay, the companies are performing, they're doing their job better, but somewhere the market is overall either their market is not confident about the companies. All right, so this is something that comes out in the earning yield. Then the valuations of the companies, industry wise I've taken. So I always believe valuations have to be commented, at industry level or sector level and not at a market level. Many of us, keep looking at Nifty P and all that. So I think it should be at sector level. Okay, that's when it makes more sense. So the long-term average, if you see for, auto sector, for instance, to start with, the long-term average, I think this is a 3-year average P is 16 times. Currently, it's around 25 times for auto. So can we say that it is trading at premium? Okay, that's the point here. Okay, so as you see, most of the sectors here, auto, consumer discretionary, for example, cement, okay, or even consumer staples, IT services, overall, you see that most of them are, the ones which are in this color, green color, they are trading in premium. Okay, now you all know P ratio can be interpreted affected both way. You can think that they're overvalued. The market is overconfident on them, or maybe the market is finding these stocks more attractive, these industries more attractive. I think that's what we can take out from this. You also have other industries, private banks, for instance, tobacco, electric utilities, okay, PSU banks and metals. There again, you can take it as undervalued sectors by the market, or market does not have confidence on them. So we might have to dig a little more into them and try to find out if any of you have any holdings into these sectors, relook at the valuations there. So that's basically the current situation. Okay, these numbers are based on 12-month forward P, and this is as on June, end of June. These numbers have been taken as an end of June, the Q1 results based. Okay, and one final section in my presentation, I just take another 5 to 6 minutes. So the global financial market numbers. Okay, so Professor Kiran already spoke about this, the estimate of the global growth rate. Okay, which has been, it was nearly like 6.1% was the estimate, which was brought down to nearly 3% for 22 and 23. You can see advanced economies, they're predicting to be 3.3%. Okay, emerging markets also, it's around 3.8%, which is clearly because of the pandemic and the Ukraine war, and these kind of unstable mood in the overall economies, almost all the economies. And global markets have also been, they don't have a better scene than Indian scene. In fact, so much so they have a negative, more negative picture to look at. Okay, so especially if you look at Russell 2000, which is basically a small cap index of the global, it basically lists down all the top 2000 small cap indices, small cap stocks indices. So small cap stocks index, Russell 2000, that is down by 22.5%. Okay, Nasdaq, of course, is the large and mid cap. So then you have the fixed income securities. Okay, again, here we are talking about return from the indices. Okay, so this is not the number as such, it's a return, like global. This is global number. Corporate and government bonds have given year to date. Okay, we are interested in this part, right? So minus 10.57. And incidentally, by the way, when I say YTD, it's from Jan to June. Okay, so 10.57% negative, return on these bonds. So basically, the yield has gone down by 10.57%. Okay, that's one. Even high yield bonds have, high yield bonds, what we call as, sometimes we use the word junk bond also here. Even they have also, despite taking so much risk, they have given the most, they are the most hurt in terms of bond market. I mean, you must know that, bond markets are the much larger market than the equity markets in the global financial market space. This is, the sectoral performance, again, S&P in this index space. So which are just wanted to get an overview on which sectors are actually doing well, which sectors are the one which are pulling back the numbers. So you see that utilities, energy, healthcare, mostly on the public sector. Okay, consumer staples are the ones which are, positive, whereas you have all other major industries, including your financials, real estate, okay, manufacturing, okay, IT, communication. If you see, these are the driving industries, right? The growth drivers we call as. They haven't been giving great returns. Of course, it's connected to the equity market performance overall. Okay, but yeah, the fact is this. Okay, and this was another interesting statistic that I found, which is the CIO view. Okay, Chief Investment Officer view. Basically, the top portfolio managers and their current position. Again, these numbers are as on June. Okay, published in July, so based on June. Okay, so this is the overall view based on the portfolio holdings by the CIOs. Okay, CIOs are basically fund managers, whom we call as. Okay, which are the sectors where fund managers are overweight? Coincidentally, in the list of sectors that we have given here, none of the sectors the fund managers are overweight. Overall, it gives me a feeling that fund managers are also taking a cautious view on the market in terms of taking any radical calls. Okay, in their investments. Basically, this is no time to experiment. Okay, that's basically one message that we can get by looking at all these performances and at a global level. Okay, so yeah, currency and commodity, we again spoke already. I told you it's kind of extremely volatile, and I'm not commenting on this based on volatile information. Almost every month when we're tracking this number, it's changing. This is from there is a website called Capital Market. Okay, not an Indian one, global one. So Capital Market, they come out with this report every month. So I generally track this every month. So every month, this particular part or this particular slide has a different picture. All right. So, and finally, I'll just conclude with this slide. This is something that I found when I was researching. McKinsey has conducted, post-pandemic, post-pandemic and post the war. Recently, they have conducted a survey, where they tried to find out from the, economists and policymakers in different countries, what are the potential risks that countries are scared of, which might hinder their growth in the coming days. All right. So 3 reasons have been quoted, and one is inflation, geopolitical instability or conflict, basically wars and etc., and the supply chain disruptions. Okay, of course, all the 3 are interconnected with each other. That's a different argument. But even if I ask you independently, what are you concerned about? What is making you, be threatened about the next 6 months performance or next 12 months performance? I'm sorry. Okay, so most of them have, and they're doing this on a quarter on quarter basis. Last 2 quarters, if you see the major threat, of course, in the month of March 2022, I think it's no brainer. You ask anybody, they would have said geopolitical instability is because Russia-Ukraine war was at its peak, right? So naturally, but right now the concern for almost all the countries is inflation. Okay, which is also reflecting in what RBI is doing for the last, 2 monetary policy reviews. In the month of May, they increased the, interest rates, and even in the month of June also they've increased the rates. So I guess that's there. I mean, hoping that will be able to control the inflation and we will not be moving in a wrong direction. But having said that, it's also a global scenario. Okay, so I think I would like to stop here. I'm also running out of time on what I promised to cover. So I hope, my slides have, complemented Professor Kiran. So now I think we can take few questions. So thank you all. Thank you, Professor Kiran sir, for encouraging. I think sir thanked his student, but I would like to thank him because he gave me some directions on last week. Also, we had a discussion. So thank you so much for giving this lecture. Thank you, sir. And thanks, Victoria, and thank you, Anandu. Thank you, Stock Market Institute.
Yeah, I think we can have some kind of discussion between both of you in case if it is required, or else we are open to questions.
You had a very nice, interesting slide there called the CIO slide.
View. Yes. Sure, sir.
Yeah. So here I would kind of complement what sir said. Let us look at the neutral stance of the CIOs, and you will observe that energy and financials, energy because of inflation, energy prices are going up, oil prices are going up. That is why people are neutral on that and they are invested in that.
Yes,
and then financials because interest rates have already peaked.
Yes.
Don't expect a further increase in interest rates, so bond yields may stabilize. That is the expectations that they are having, and that is why people are also neutral on financials. They are not underweight. They are not having a negative view. And then real estate, once again, when inflation is high, real estate values will go up. Material, once again, inflation is high, material value will go up. And then healthcare is defensive because it's a low beta. People will go to the hospital in case of even though they have 100 rupees in their pocket or 1,000 rupees, if they have to take a medicine, they have to take. And then you will see the overweight was green and the neutral was orange. In the neutral utilities, once again, low beta. We need water and electricity no matter what. And then information technology kind of bucks the trend because that is more tech intensive, and your Amazons and Teslas of the world really are not too much concerned about many of these Fed actions, although car sales does get affected by the interest rates. So that's why they're neutral on that. And consumer discretionary, when inflation is skyrocketing, consumers will stop buying your 85-inch television. They will stop going to the Walmart, or in India, they'll stop going to the DMart. They'll postpone their purchases. So that's why consumer discretionary, they are underweight slightly. But consumer staples, now that is consumer staples is what something that we can't do without. The Britannias of the world, they are taking a big hit. So customers are really tightening their belts. They are really getting hurt.
Yes, sir.
And then the next slide, sir, was very interesting too. So this slide, incidentally, look, the year to date, only commodities have given you positive returns, 18.5% positive returns. That is primarily because of inflation. Commodity prices are going up.
Going up.
That's crude oil. Crude oil is all over the place. And 42.2 is the percentage returns in the year to date terms. And then gold. Gold is like a mother's arms when bad things happens. So gold should have gone up, but it has not gone up that much. And then the currency markets are giving a very interesting signal. Look at the euro. Euro has really cracked against the dollar because of the pressures within the eurozone, and the 30 countries may not even come out of this crisis as one single unit. Recently, Germany entered into an era wherein their current account deficit first time in a very long time. So euro is looking at parity to a dollar. And when that happens, then Europeans are going to buy, Europeans are going to welcome a lot of Americans, definitely, because who would want to visit Paris when you have to pay $2 and buy €1? But you will obviously want to visit Paris when $1 buys €1. So more tourism may happen in Europe, but certainly parity is not a good thing for most European countries. And then Japanese, all emerging market currencies, all currencies have taken a hit because the US dollar is like the harbor when there is a storm, the US dollar, because it commands that kind of a respect. And the dollar prices have really shot up. So yeah, very nice, very nice presentation, sir. Very colorful and very poignant and very well depicted. Mine was a little unglamorous and little too old types, and you are Star TV types.
So we both know how we all make PPTs.
Look at Argentinian peso. Argentina has always been the sick man of Latin America. I mean, the Argentinian sovereign default is like a given thing. Once every 10 years, they will default. And look at the way they have devalued against the US dollar. And surprisingly, Brazil has bucked the trend. Brazil has strengthened against the dollar. I wonder what magic the Brazilians have been doing, or what commodity.
Again, commodities, sir. Brazil is commodity-based, rubber and coffee, I guess.
Yeah, exactly. I wish poor Sri Lanka had some commodity to back on. They would have also kind of bucked the trend, but unfortunately, no such luck. So yeah, so this is a nice 6 months, interesting 6 months we have lived through. I never thought so many changes would take place.
So many learnings for us also. I mean,
a
lot of things we haven't heard,
Exactly.
For me also at personal level, I've been wondering everything, seemed to be not possible is happening. So
yeah, and
interesting times for learners.
Yeah, we always think that if we put 60% in equities and 40% in debt, we are well diversified. Markowitz said so. But the correlation has dropped correlation has become one. You put in equities, you put in bonds, both have gone down at the same time, and you're sitting on losses.
Including gold and commodities. Yes, sir.
So now we have to think what Markowitz would have done during this time. But someone else has to do some more research on when these sort of events happen. What is the solution to that?
In fact, I was thinking of a concluding remark, generally to give a punchline. In economics, every theory that we present, we say ceteris paribus, keeping everything else constant. Now, unfortunately, nothing is constant now. We can't, all those things which we assume to be constant in economic theories are changing. I guess, what we are witnessing is that. So that's why I keep saying, for the learners, my students also, this is the high time for you to learn, everything that's happening. Don't miss even a single news about economy. I think a lot of things are changing.
Yeah, true. It's never stay in the same place. Things are changing, and the rate of change is also changing. So that's why it's called a stochastic change. There are small steps in the price movement. There are large jumps in price movements.
and the models break down and there is a model risk, and things get aggravated when everybody is using the same strategy to hedge or the same strategy to make money out of, and they are caught on the wrong foot. And hopefully we have not seen the spate of sovereign defaults, but that is also quite likely because China
Yes.
is another real estate company has missed another coupon payment after
Yes.
the previous one had large fallout. But somehow they managed to not allow the news to come out of what happens there, unlike the Western press, which tells us that Lehman Brothers collapsed and some other bank was taken over by someone else, and there's a very transparent reporting. But that does not happen in the case of, unfortunately, China. So we do not know the extent of the contagion that is going to travel, because a lot of these bonds are held by pension funds and sovereign wealth funds. And if they start missing coupon payments like that, then there's a cascading effect on the other participants, and
Yes.
that's bad news for everybody. But in sitting in India, we are kind of protected against this because the regulator frowns upon investing aggressively in all of this sort of foreign securities, where the regulations are lax, or we do not know the kind of regulations that are there. So by far we have sat out of the storm, but certainly it looks like from all angles that we are headed into a storm.
There is a tolerance zone for India also, sir.
Yeah.
The consumer demand or the FDI attractiveness also has a limit to cross. So hopefully that's far away, but yeah.
So there are a couple of questions from people. I think we can get into question and answer sessions. If anyone has questions, please write on the chat box, or else unmute. They can unmute. Yeah, you can unmute and ask question. Meanwhile, there is a question. I'm not sure. I didn't understand much. From Srivas, source of different currency. I didn't understand this part. So if you're able to understand what exactly it is, you could answer, any one of you. Source of different currency.
You mean the source of data, Mr. Srivas? Is that your question? Where did I get that data from? This data from?
Yeah, source of different currency could be that. Yes.
Yeah, my source for this is this one, Capital Market Outlook. It's available. It's an open source, so it's available. Capital Market Outlook.
So there is.
Sorry. This one is Bloomberg. I'm sorry. This source. The first three slides. The source is Bloomberg. I'm assuming, Srivas, you are asking about that. But yeah. Anyways, you don't need a source for this. I mean, you take Indian currency. What was the January number and what is it now? You see the change. You will know it's 4.13%. There is one more question here. Q&A. I think if Professor Kiran can take it over, it will help. Sir, should people invest in commodities in short term rather than equities? Is a question from Kishore BS.
Yes, you should probably invest in commodities and do it on a regular basis as a part of your portfolio investing, and try to invest in a commodity index, mutual funds that invest in commodity indexes. They will be in a position to manage your exposure better and kind of protect you with the downside risk rather than learning from scratch yourself. Yes, it's a good idea to stay invested in commodities. Staying invested is important, not going investing when the world is on fire, literally. I just wanted to kind of share a small link to those who are keen on the various currency values at the moment. So you could see it fluctuating and all of that. So I just shared it in the chat box.
So to add to, sir, you correct me if is my understanding correct. I know when we want to invest in commodities, in mutual funds, we have this fund of funds. Especially some funds are there which invest in the mining companies of commodities. So that can also be one of the one of the
Absolutely.
options that you can explore into.
Absolutely, you can go ahead and do that also. Just be mindful of the fact that when you're investing in mutual fund, there is an asset management fees that you pay. So that gets magnified when you invest in fund of funds, because there are two levels of asset management fees that will go out. So one just needs to be mindful of that, and if one is okay and comfortable with paying that kind of asset management fees, then by all means, please go ahead.
So Rita is asking, as we know, our investment market is going down, then where to invest?
I'm not sure it is really going down.
Right.
I'm thinking we are doing reasonably okay. When you go up 70% and then fall 13%, it is not going down. It is like taking a pause. Even after playing tennis, after one or two games, the players sit down for a little rest. So I think it's an accumulation. And given the fact that there are so many global turbulences and sovereign defaults all around us, one country is already bankrupt, the other seems to be teetering on the verge. I think we are doing reasonably okay. I don't think we should be that pessimistic about our markets. We should still have confidence and go ahead and pick those stocks that are trading at a discount, which would never have happened if everything was hunky-dory. This is a buying opportunity for those people who believe in the company and the theme, and if that sector is growing. If you believe Indians are going to spend more money in the future, tomorrow is going to be better than today, I think we should buy all of those companies that you could not have otherwise bought. They've corrected beautifully.
True, sir. True.
So there is a question by Shrivas. Why Russian ruble is appreciating in comparison with dollar? So any one of you can answer this.
Yeah, let me just pull out the Russian ruble, and if I could be allowed to kind of share my screen, that would be nice. Can I just share my screen? Would that be possible?
Possible. Just hold on.
Because without the data in front of us.
So meanwhile, people, in case if you have any questions, kindly type in on a chat box or a Q&A, or else you can raise your hand, we can unmute you. Meanwhile.
My desktop, please. Just Kiran Bindu, not the other one.
Before you show your screen, there's one more question. I'll read out. Is SIP a good option for investing money in?
I'll take it. So,
meanwhile.
Yeah. See, as long as your investment horizon is long run, okay, when I say long run, according to me, it is at least, if you're in 20s, I would say at least 10 years. Okay. As long as you're accumulating it for a long period of time, okay, SIP is a good investment at any age. I hope that kind of answers. So the reason why I say this is the very purpose of SIP is to buy at all levels of the stock price trend. Okay, so you end up buying at a lower price also, you end up buying at high price also, especially in volatile markets like right now. Okay, we don't know, at least as it stands now. I think SIPs will definitely make a good option. But again, like a general suggestion for all the, all the investment questions that you're asking right now, there is no, better or a worse time for investment. You can always invest. It's just that your investment should be based on certain knowledge. All right. So gain knowledge and invest instead of, a crude method saying that, okay, X person has invested in this and he earned 20% return. So I'll also make. It doesn't work that way. You need to gain knowledge. You need to understand what drives the return. For example, if I'm investing in SIP, which fund am I going to invest in? How does it fit into my overall asset allocation? And all these things have to be kept in mind before you invest. So knowledge-based investing is what I am generally proposing in the last few months or so. Okay, so as long as you do that, I think SIP is definitely a good option.
So on behalf of all the students, because we find a lot of students here, So what is the advice you give them? Because I don't want them to be confused by seeing the entire graph that you showed on all the areas or segments. So what is the kind of suggestion you would give a student for them to understand about overall economic review?
So before you answer that, I'll just finish with the ruble.
Yes, sir. Yes.
Please look at the ruble.
Yes.
The journey of the ruble since 1997 is on your screen. That first spike in 1997, little after 1997, is the first default of Russia under Boris Yeltsin. And then somewhat it was at 30 to $1. And then again it spiked sometime in 2014. So you see the episodes of crisis in Russia causes ruble to depreciate against the dollar. And notice this time it spiked almost to 120 with the Russian war, and it has fallen down from 120 levels. So after having gotten beaten so badly, the Russian ruble is now coming back. That's all it is. It's nothing more, literally.
So the number you saw there was only for the last 6 months. In the slide, what they saw is only for 6 months.
So if it's 1 month, if it's 1 year, there you go, 1 year. From January it devalued. I just probably there you go, 1 hour, 1 week. There you go, January 22, where it was in January 22. See that? January 22. And then there is a massive devaluation of ruble thanks to the war. And now it is coming back from 120 levels. So that's why ruble seems like it is doing much better against the dollar, because it has gotten hammered so badly. Yeah, that's it.
Thank you, sir, for the answer.
Yeah, so now back to the question that was being asked. The question was clarity, something to do with clarity, right? So the clarity is still.
Yeah.
I mean, clarity can only be obtained by a sustained reading and education, which we encourage everyone to undertake. And it is only a continuum. We have been following the market since 1992. And that is why we have a sense of history of the market. And the moment you say Russia, we can immediately pull out the chart and tell you what happened in 1998. So that gives you a context. So for a 21, 22-year-old, I would suggest a large dose of patience and continuously monitoring the market of various asset classes, what's happening in equities, what's happening in bonds, currencies, and what are the various central banks telling. So following Bloomberg, following investing.com, and then of course attending all the lectures that you hear on stuff like that.
So there is another question. What is the best time period for investing in short term to get high ROI?
Okay, can I take that, sir?
Yeah,
because answering that is the easiest one. There is no such thing called high ROA in short term. If you know, tell us. We all will leave this business and take that. So I don't understand why, as youngsters and students like you, want to make quick money. Okay, quick money is never enough money. Please understand. Okay. Equity markets, if you're entering into, you have to enter with a long-term orientation. You might end up making within a day. I'm not saying that, but when you're putting in your money, when you're sacrificing the use of that money, you have to keep in mind that even if I'm not going to get back the money in the next 3 years, I'm still okay with that. Only such funds have to be invested in the long term. All right. So that is why I am not personally recommending any short-term investment for you if you are youngster who is looking for building your wealth. But yes, for a learning sake, or for, as a business, for example, I want to speculate and do some technical analysis and invest. Yes, that way, even in a bear market, technical analysis will give you trends, right? You don't need a bullish market. You don't need a, stable market. In all markets, technical analysis will give you trends. Of course, there are a lot of these sessions in StockBite itself, which teach you technical analysis, right? So in that, you have strategies to buy in the morning, sell in the evening, and make quick money, right? So that is a different calculation. That's a different ballgame. But then don't use the words investing. You can say that I want to speculate and make money, and I want to spend more. In that case, of course, you have to spend more time in trading in the market. Yeah.
Thank you, sir. There is one more question, sir. This is from Rita. Sir, due to inflation is coming in coming years, hunger and starvation is going to increase. Is it true? Is it true? Is a question. So inflation can lead to hunger and starvation. I don't think so. We'll reach that kind of a situation, Kiran. Any one of you can answer this.
Food production is also going up. Distribution of food is also going up. There is a World Hunger Protection Program by United Nations. So countries that need to worry about hunger and starvation are on the very low level of the hunger index. And they probably need to worry. But if they reach that level, there is going to be bilateral aid and multilateral aid that is going to flow in. And I think the extreme poverty we have tackled pretty well in the last 30 years, especially with significant amount of households in both India, Bangladesh, and also in China for that matter, going above the poverty level. So the instances of malnutrition and wasting of the young babies and the fat tummy that you would see when Africa famine images would be beamed, those have gone down significantly thanks to the security net of the UN and other multilateral organizations. I don't think that is a real big worry. Yes, affordability of food is a worry. The quality of nutrition is a worry. Whether people are able to have the adequate calorie intake to justify their needs, that is a worry.
Thank you, sir, for this answer. And there is another question. How long can we study a particular company and invest in?
Okay, I'll take it.
Is there to study about a company?
Okay, I guess I want to kind of rephrase the question of Dinesh. If I were to rightly understand, I'm answering the right question. You're asking, what is the period of time that I should stay invested if I buy a company's stock? Okay, time in. Okay, if that is your question, or is it that how long I need to study the company itself?
How long we need to study about the company itself, according to my knowledge?
I think. I don't know. I don't have an answer for that. I can do a study of a company within a day and know about it. Basically, you have to learn how to do a valuation of a company, right? What is the right value according to you, and when is that value is going to get unlocked in the price of the market price? That's basically your target. Now you can do that within a day. You can track it for the next 6 months and try to see how it performs. Okay, so I really don't think there is any time period that you can set within which you need to. Okay, so moreover, when you do analyze a company, it also remember it includes analyzing the economy, analyzing the industry, analyzing the trends that are coming up, right? Risks involved. Okay, financial analysis, operational analysis. So there's so much involved. Okay, so that's one. But if you are again going back to the technical analysis, if you are talking from technical trends and patterns, how long should I observe? Should I take a 1 day? And a 1 day period and analyze, or should I take a 3 day period or a 1 week, 1 month period? I think that again depends on if you can still do a daily analysis and take a call for your next day's move, right? Next day what you're going to do. You can take a monthly chart, candlestick chart, and identify the patterns, and you can decide what is going to be your next month's for the next 1 month, what is going to be my take on this particular stock. So whatever candlestick chart frequency that you take, in a thumb rule basis or a crude basis, you can say that that is a period for which you can take your calls also. All right. Yeah.
Thank
So,
you. There's another
I'll just add
question.
a couple of sentences to that.
Yeah. Thank you.
Fundamental analysis, I normally look at a 5-year period because that gives you a good sense of a couple of trade cycles of how this company has survived. And also, I try to watch for certain obvious red flags. If the profitability ratios have suddenly jerked up because of one extraordinary item that has been fitted there below the line and things like that. So yes, couple of hours is usually what I would devote to looking at a company's lifting the hood and seeing what is inside. That is a financial statement analysis. I do a horizontal and a vertical analysis and few ratio analysis, profitability ratio. I look at the trends of that. And then I put that in the context of sectoral numbers of what the peer group companies are trading at and work out the PE multiples. All of this takes me a couple of hours to do, but it takes me a couple of hours because I've been doing it for donkey's years now. If you start to do it, it would take you much longer. So most of these videos of all these sort of analysis which we have discussed is there on the app. I think you should take a look at it. You will get a sense of how to do that analysis.
Okay, there is a question. Do you think inflation will get worse by 23-24? This question is from Aryan. 23-24.
Today with the clear intent of not doing any forecasting. Because 90% of all forecasts are wrong. But if he is going to hold a gun to our head, then I would hazard a guess that inflation is probably going to come down because all the central banks are hell-bent upon pulling down the inflation. But the fallout of that would be quite ugly. The fallout of that would be recession and reduced employment and prolonged sustained pain. So it is like, do I need a headache or do I need a toothache? Select between anyone. That's my sense. I think the question
Thank you,
is.
sir. Thank you for this answer. Is there any other question? I think I see one more question. What is the stop loss? Okay, so you may have to explain this in short. Somebody.
Stop loss is when you place an order, Pushparaj, I guess, when you place an order to buy a stock, okay, you can also give another level of price below which you don't want the share to be in your portfolio. Okay, let's say if you're buying it at 100 rupees, you can give a stop loss at, let's say, 80 rupees. Okay, so worst case, after you buy, the stock price starts falling. Maximum loss that you can, you want to take, let's say, is only 20 rupees. So as soon as it hits 80, if at all it hits 80, the stock gets sold on its own. That is stop loss.
Thank you so much. You explained it in, in a very short and very sweet manner. There's another question from Rohit. Sir, can I know from which source do you get all the graph and chart? It is, Rohit, I want to answer this. It is not that there is a lot of research gone in to present this 1 hour of session, almost a week or 10 days. Both of them has been trying to check out because it is the result of January to June. This is a mid-year economic review. So 6 months data has to be taken. So maybe Kiran will answer a couple of from Bloomberg, he said, and Capital. I think, Kiran, you can answer from where you got all the data charts.
Rohit, Rohit, I'll tell you, if you are asking about the source of our data, what Professor Kiran and myself have presented, I think I showed you. One is, of course, the IMF data for all the global data, and of course from Bloomberg and all that. But if you're asking, the graph and chart, like the one which Professor Kiran showed, when the USD ruble question was being answered, to generate a candlestick chart or a technical chart, we call it as. If that is what you are interested in, you can explore, moneycontrol.com. Yahoo Finance also gives you. Investing.com is what I think Sir has also used, and that even I have used, and it's really good. Okay, investing.com you can try. You can just go to their website, type any stock name. In addition to all the details, it also gives you a technical chart. so that if you learn how to use it, you can generate technical charts.
Yeah. So I also want to, mention here one of our intern, Arya, who is an economic student from missed out the college where he's studying. He also did a lot of research, almost 15 days. So an intern can do it. You can also do it. He's studying his first year master's in economics.
Okay.
Yeah. So you all can do it, guys. Yeah, you just have to do little more research, little more Googling. Yeah, there is another question from Rojaj Shrestha. Sir, what is your thought for upcoming recession? Will it hit severely than the previous one, and how to get a safe side on it? So any one of you can answer.
Professor Kiran, please go ahead.
Basically, recession in India is like you're not able to drive on the top gear, you're driving in the third gear. So the growth rate falls to about 4%, 5% rather than 8%. If you look at how India has grown post 1991, there have been only 11 instances where India grew at greater than 7% per annum. And what happens when India does not grow well? The employment opportunities does not get created that much. And we have a huge population coming into the labor force. We have an Australia that turns 18 every year. Literally, that is the amount of number of people that turn 18 and that come into the job market. So we need to grow significantly. And if the world economy is not conducive for that growth, then who do we export to? There's only so much we can trade amongst ourselves. And unfortunately, we don't live in a neighborhood wherein bilateral trade can be expected to grow significantly in the coming years, because most of them have literally been in financial shambles for decades together now. And for them to fix their house in an order will take a very long time. So India will grow at 4 to 5%. You don't need to do anything for India to grow at 4 to 5%. It will grow at that rate if there is a recession. I don't see a negative growth rate of 2 quarters in India because there is so much of demand for everything. India is a case wherein the supply side has to buck up and there is a demand for everything. Literally, from the moment you wake up, 1.3 billion people will demand milk. They will demand transportation. They will demand birthday cakes. There is demand for everything. Parle-G. In India, there is no shortage of demand. The issue is, can the supply side keep up? So we won't have a situation like Germany or France, which has got a very tiny population base. So if there is a recession, we will grow at a lower rate. That's my sense.
Kiran, you have anything to say? Kiran,
no, I think pretty much sir covered it. So
okay. Anything else you have any other question? I think we have covered most of their questions. We have another 1 or 2 minutes to answer all your questions. In case if you have any question, please type in quickly. If not, we will leave the email ID on the chat box. You can always, anything related, not necessarily mid-year economic review. It can be anything related to finance. If you have any questions, you can write to us. We will reply to you with our best knowledge. Any questions, people? Any questions?
So to all of you who joined today and who stayed on till the very end, we will just like to leave you with a couple of pointers. If you want to get really good in finance, there are 2 things that you need to be pretty good at. One is currency and another is bonds. Now, these are technical. You need to understand how the yield curve fluctuates and what it means when the short end of the yield curve fluctuates more than the long end of the yield curve. And what am I even talking? So please read up more on currencies and bonds. That's the shortcut to becoming really good in finance. Most of you all would probably stay put in the equity market side of it, but equity is fine. Go to the bonds and the currency markets, and there you will find that there's a lot of technical stuff. And of course, please follow the Nobel laureates on Twitter. like your Paul Krugman and all of these people, what they say makes a lot of sense in the context of global economy, the way it is moving. And of course, when you find the time, if you have the time, please do read Macroeconomics by Paul Samuelson. That is a kind of a base on which you can build all other knowledge on.
So, sir, I always find people with this conversation, I understood that people are fearing about future. So for all this young generation, what is the kind of suggestion that you want to give? Both of you, I want you both to give some suggestion, soothing suggestion, so that, the fear is out of their mind, because everybody is fearing about maybe pandemic or war, or it could be anything. They're fearing about a lot of things. So what is the suggestion that you would like to give?
Sir, Kiran sir, go ahead.
A simple suggestion in a very simple manner. What is that you want to tell?
You saw COVID. Just imagine March 24, 25, March 30th of 2021, COVID, we were literally counting the number of people died or contacted COVID, it was in 10, 8, news channels used to report that. Okay. And what was the level of fear that you had in your head? Okay. And see, today we sailed through that. Yes, we sailed, of course, there were some losses, but it was not that bigger damage that happened, right? So same way, if I go back to any crisis in the past, okay, health crisis or economic crisis, it has always resulted in a different, it has always accelerated a slow moving trend. Please understand that. Okay, every crisis accelerates a slow moving trend. You need to understand that. Okay, so this is actually, whatever you're going through right now is going to, end up and leave you in a much more, bullish, environment. I think I am more confident of that. Okay, and if you should just look at, one thing that keeps confidence is, if you ask me, my personal thing, my personal income has been consistently going up. Okay, and I'm all the company stocks that I've been buying, their profits have been consistently going up. Right? India's GDP has been growing up. Okay, despite all these things, it will continue to do well. See, all these numbers are just telling us what direction we should take in the investment or understanding the economy. That's all. They no way say that how your life is going to be. Okay, these are learning things, and these won't. I mean, we will always find ways to create our portfolios, make our earnings in a right way. We will sail through that. So there is no way that you have to be fearful, and especially don't get carried away by all the news that you hear about, this country, that country. You are in a much better economy, stable economy. There are a lot of think tanks who are taking a call on economic policies. So I don't see any reason for you to be fearful. I mean, more so, you should be more confident than even what I was when I was passing out of my college. So don't be really, scared of anything. Yeah.
Thanks, Kiran, and thanks, Kiran Bindu sir. Wonderful answer you gave.
Kiran Bindu sir is still not. I'm actually looking forward for his.
Yeah. Kiran Bindu sir, you may have to say at least 1 or 2 lines for the students or whoever is watching today, who's fearing about future. It could be money or health, because the last year we were worried about health. This year we are worried about money. So kindly tell us something, sir.
All right. So when you think about the future, there is a known and there is a known unknown. Yes. And what really scares us is the unknown. Okay, which we can't really control. Known, yes. Known unknown, health. So we have to go out for a run or a walk or eat sensibly or follow a particular diet and preserve our health. Now, when it comes to the future, the career, I believe truly that the next 30 years, Indians are going to be buying more houses. They're going to be buying more cars. They're going to be going on more vacations. They're going to be having more leisure time. They are going to explode in population. They are going to be traveling abroad more. More people are going to come to India. But this opens up a lot of opportunities for everybody who wants to get up at 6 in the morning and then starts to hustle. There is no room for being lackadaisical, no room for being pessimistic. You are living in an economy that is growing at the fastest rate in the world. And if you can't earn a decent livelihood for yourself here, then pretty much there is no other place on the planet that you would flourish. So next 30 years, I believe, I'm looking forward to the next 30 years, my health willing, to participate in the economy and see how things pan out. So you should be very optimistic. You are living in really wonderful times, and it has taken a lot of effort to come to this level. From 1991 till now has taken a lot of effort. And please don't take things for granted. The metro construction has happened right in front of you. You can get to places faster. There are new buildings coming up, new office building, comfortable place for you to sit and work. We have sat in literally dingy places in Pina doing accounting work back in the 1990s. And today you get to sit and we work in a beautiful, all carpeted environment. You should be really, really thanking your stars that a generation that has gone by has worked so hard to bring it up to this level. And now the next 30 years, the baton passes and you need to take it and run it forward. There is absolutely no need to be anything but enormously confident that tomorrow is going to be great.
Amazing, sir.
Thank you for this confidence, sir. With this, I think we can wind up because it's almost 2 hours of discussion, and I know you both of you are tired. And everyone will have more questions. As I said, you can write to us to the email ID on the chat box. Yeah, thank you so much for everyone. And second thing is, if anybody is interested for certificate, having a certificate, I understand many of you want to have a certificate. Click on the link and apply for certificate. You will be able to get it. Thank you so much, Kiran Bindu sir. Thank you so much, Kiran K, for a wonderful session today. If we had more time, maybe we would have spent more time. Thank you so much. For everyone, dinner time. Good night and take care. Thank you so much, sir.
Thank you so much. Thank you, Mr. Kiran.
Thank you, sir. Thank you for your support. Yeah, thank you all.